All right, welcome back to 0.5%. This is episode 14, part 1. We're going to start off this episode with a little bit of night research, daily research, whatever you want to call it. So I'm right here on FinViz. We can just take a look. You can see the Dow opened today much lower than its previous close. Had a little bit of a recovery around lunchtime, and then proceeded to close lower or a little bit higher at the very end of the day. And the following indexes, NASDAQ as well, the S&P 500, the Russell 2000. I think the most significant actually was on the Dow though. So I wouldn't be surprised if the NASDAQ slightly trails the market, but it will be a more rapid recovery once it gets started. That's what I think. I'm not sure. We can see the heat map here. I'll go ahead and expand that. It's primarily though a bloodbath. What industry or what sectors were up? As far as the S&P 500 goes, we've got a little bit of progress in healthcare, in consumer defense, your Walmarts, your what is that? Procter and Gamble, Coca-Cola. Let's come check out the world. So the world didn't seem to do so good today. What is this? How long should I exercise? Heard of that. Alright, so it looks like the world was, in general, pretty down today. I don't know what's going on in South Africa, but I bet they didn't retaliate against any tariffs. Seems to be the way things are going nowadays. Let's open up exchange trade funds. This is the U.S. Actually, all of this. Then we got fixed income, international, volatility, global, and commodity. So just in general within the U.S., only inverses were up. Means all markets or all sectors in the market were down essentially. You can look in sectors, even in the technology sector, the only one you see that's up is the inverse of SOX. My favorite ETF is getting demolished. It is interesting to look at though. If you look at how far down SOX was, 8.17%, versus how much the inverse is up, 22.95. So I don't know if SOX S is leveraged or not, but this does bring up a good point that I've been meaning to bring up, and it ties into how important the stop loss is. And a way to quantify this importance or this topic is a 50% loss requires a 100% recovery. You can't just recover 50% and recover a 50% loss. And to put this more in numerical form, imagine you have $100 and you lose 50%. Now you only have $50. If you gain 50% of $50, that's $25. You're only gonna be at 75. So to recoup a 50% loss of $100 down to 50, you now need a 100% gain to recoup it. So it's like every 1% down requires 2% up. Like, to break it down like even further, so you've lost 50%. Now you only have $50. To get $50 back, you need to double your money. 50% of 50 is only 25. So to break even, for example, if I'm not putting in these stop losses accurately, for every 0.5 I make, if I'm losing 0.25, I'm just staying at 0. My losses need to be less than 0.5% if I'm going to be making money on 0.5%. And I can maybe show that on an Excel spreadsheet, but let's jump back into FinViz. So this is the 1-day performance. We've been dealing with these tariffs for about a week, so let's check out the week. all you see is volatility up. Basically, the market's been up and down, and we've seen that. The market took a nice breather yesterday, and then today was kind of neutral, but I think it did dip back down. We can actually see that here. So I've got the Spider S&P 500 pulled up. So we had these massive drops, a little bit of a recovery, then a huge recovery. It was recorded on the news as like the largest one-day recovery in stock market history since, I don't know if it was ever or just so many years, but look what happened today. So it immediately opened here, low about a third of the gains that it got yesterday. That's where it lost immediately a third of them. It started to proceed up, dropped significantly, almost 2/3 of all the gains that we got yesterday, and then ended at about 50%. So about half of the gains that were recovered yesterday were wiped out. And if we look at the moving averages and what's really going on with this chart, I just think there was this massive sweep. I've said it before, all gaps must be filled. We had a gap between the fourth and the third, and then we had another gap between the third and the second. And it doesn't look like the whole gap was cleared from the third to the second. It will be eventually. This isn't the inverse. This is just the regular spider. The market will keep going up. That gap will be closed. But the back-to-back gaps were closed yesterday, or at least the second one was, and it's proceeded to go down. You can see, so these are one-day candlesticks. If you look at the x-axis, you'll see April, March. So we've got the 10-period moving average under the 20, under the 50, and the 50 isn't under the 200 yet, but the 20 and the 10 are. Everything is signaling this is going to keep going down as usual. If we're going up, we're going between the top of the Bollinger Band and the 10 period, at most the 20 period moving average. And when we're going down, we're doing the same thing. We're going from the bottom of the Bollinger Band at least to the 10, maybe the 20, but I think it's going to keep coming down. Now that we're beyond the 200, we still have so much resistance above us now. It's going to take a while. And if we look at when this last happened, so we crossed under the 200 last time here. That was in 2022. It took an entire year for the market to get out of it. In 2022, if I'm not mistaken, was when the Fed increased interest rates, and it wasn't just the spider. Like, more specifically, I think if I remember correctly, in the comparison between ChatGPT and XAI, we had asked about these time periods, and the NASDAQ was hit in particularly hard by those increased interest rate hikes. But some other things that are pretty interesting to note here, if we look at the MACD, like even back in 2022 when those rates got hiked up, we've never seen a deviation this far down. So we're over here. This is the bottom of the day, and or the bottom of the month in April. All these ones that happened back in 2022 to 2023, it's dipped an entire next segment below that. And I've gone back, I think, so the only time that it's done this recently was 2020 COVID, which was actually much worse, and it was straight down. We've already had one little hiccup of recovery, and we're on the second one. If we look at these past ones, we did see two here, but this wasn't much of one. I wouldn't say this was much of one. I don't think there's going to be a third, or at least a crossing above, while it's going to continue to remain negative. It could come down to COVID levels, or at least the upper, the depth of the 30 moving average. But I still think when that crossover happens, that's going to be the time for me to go long, jump back in to my ETFs. The important thing though is to not just get caught up in that chop, in that sideways crab walk, and I might even wait till it becomes positive again before I really get back in. We can see here in this negative and downtrend period from 2022, even though there was multiple crossovers and it shot up, like particularly right here, March 14th, 2022, there was a good up run there, and maybe I could have caught like a week or a 2 week swing, but it even got above positive and it still kept coming down. So until we see those moving averages cross actually on the chart, I'm not going to be ready to go long on any of this. Maybe crossovers, I'll do some swing trading, but I'm not going to hold any ETFs until I see positive MACD, all the moving averages up. And that kind of ties, or it's kind of a good segue into the next part. So recently I've been just trading nugget and dust. Kind of put myself on punishment there because I had one bad day, and I think it was mostly correlated with jumping around too much and just trying to do too much. So I was like, let me simplify it. Let me just stick to one ETF and the inverse of it. So when it's going up, stay there. When it's going down, go to the inverse. And it's been going well. I've learned a lot. I think you've seen that in the Let's Review the Losses videos and the weekend research videos. And the second part of this episode is going to be going over the wins that I had yesterday. So I think I did myself a good service there by just slowing it down and sticking to one thing, figuring out how it works, what are the patterns of it. But now that I'm a little bit more familiar with what these patterns look like, I'm going to go back to some of the rules of the original plan, and that's going into FinViz, seeing what's been down, what has got confirmation for the turnaround, and I might just stick with the spider and the QQQ and their inverses for now. And then once the market starts going up and my ETFs are locked into those, start day trading individual companies. But I think it's safer to keep trading the portfolio ETFs because they're a lot slower of change than the actual companies. And I can just get myself also prepared for when to hop back in. If I'm day trading the whole entire market day by day, when those start going good back to back to back, then I'll know, okay, it's ready for me to put my ETFs back in and go long. So I've been in Nugget and I've been in Dust for a while now. I think I'm going to switch that up to QQQ and SQQQ. So I'll pull those up next. We're getting close to 15 minutes, and I think this is a good stopping point. But I'll leave the screens here and just go into part 2 right from this. All right. Thank you for watching. See you next time.